In 2025, Japan raises interest rates for the first time after 17 years of dormancy. 0.25%, a number so small you'd miss it on a spreadsheet. But in 8 hours, $1.189 trillion reverses direction, flowing back to Tokyo like a tide pulled by an invisible moon. The carry trade, the machine that quietly funded 2 decades of American dominance, seizes. Treasury bonds collapse. The dollar fractures. The yen rockets. Not a fluctuation, a rupture. For the first time in modern history, the Eurodollar system, the ocean of dollars circulating outside America, bends not to the Federal Reserve, but to the Bank of Japan. The truth that should terrify you: the nation holding America's largest foreign debt is the same nation capable of detonating the dollar's foundation with a single policy shift. One microscopic rate hike, one decision in Tokyo, and the architecture holding up global finance starts to crack. So ask yourself this: if a single decision by the Bank of Japan can reverse global monetary power, is the dollar truly strong? Or only strong when Japan allows it to be? And what happens now that Japan has decided to stop? Rewind to the 90s. Japan's economy implodes. The bubble bursts. Growth flatlines. What follows isn't a recession, it's a decade-long coma. They call it the lost decade. Interest rates hit zero. Public debt explodes to levels the world has never seen. And Japan, once the rising superpower poised to overtake America, becomes something else entirely. A liquidity factory. Zero-rate yen floods the planet. Cheap, endless, reliable. And the world gorges on it. Treasuries at a scale that keeps American borrowing costs from spiraling into chaos. They don't do it for charity. They do it because their economy depends on a stable dollar system. But here's what nobody admits: Japan doesn't just participate in that system. Japan underwrites it. Throughout the 2010s, the carry trade becomes the invisible engine of global finance. Borrow yen at zero. Buy American assets yielding 3, 4, 5%. Leverage it 10 times. Repeat. Hedge funds do it. Pension systems do it. Sovereign wealth funds do it. The entire architecture of modern finance calibrates itself to one assumption: Japan will never raise rates. Not next year, not in 10 years, not ever. Markets stop pricing risk into this trade. Why would they? For 17 years straight, the assumption holds true. And beneath all the confidence, all the growth, all the wealth creation, sits a single uncomfortable truth that nobody wants to say out loud. American financial dominance, the power of the dollar, the depth of treasury markets, the liquidity of Wall Street doesn't rest on American strength alone. It rests on Japanese compliance. The world mistakes this arrangement for natural order, permanent, structural, inevitable, but it was never permanent. It was conditional. And the condition just changed. The carry trade sounds almost boring when you break it down. Borrow yen at 0%. Treasuries yielding 3 to 4%. Leverage it 10 times. Pocket the spread. Simple arbitrage. Risk-free profit. Except it's not a profit strategy. It's a liquidity pipeline, and every major financial institution on Earth is plugged into it. Here's the metaphor that makes it clear. Think of the dollar as a massive suspension bridge stretching across the global economy. Impressive, engineered, trusted by millions. But the yen. The yen is the thin steel cable running underneath, bearing the entire load. Cut that cable, and the bridge doesn't just sway, it collapses. Now here's the part most people never realize. 70% of dollar-denominated assets across Asia are funded using yen as collateral. 70%. That means the majority of dollars circulating outside the United States, the dollar's financing corporations in Singapore, real estate in Hong Kong, infrastructure in Indonesia don't exist because of the Federal Reserve. They exist because of the Bank of Japan. This is the Eurodollar system. Currency that America doesn't control, can't print, and has no direct authority over. It's a shadow dollar supply bigger than the domestic one, and it runs on one fuel: cheap yen. Without cheap yen, the Eurodollar system doesn't just slow down. It stops. Let me show you how the machine actually works. A global bank in London holds yen-denominated liabilities money it borrowed in Tokyo at near zero rates. S. Treasuries corporate bonds mortgage-backed securities. The profit comes from the rate differential borrow at 0. Earn at 3 or 4. The risk comes from currency movement. As long as the yen stays weak and stable, everyone wins. The bank earns. Investors collect yield. Liquidity flows freely through the system. But if the yen strengthens even slightly, the equation inverts. Suddenly, the yen debt becomes more expensive to service. The dollar assets lose relative value. The profitable spread turns into a widening loss. And here's where leverage becomes lethal. When you borrow at 10-to-1 leverage, a small currency move doesn't just hurt, it obliterates. A 2% shift in the yen can wipe out 20% of your capital. A 5% move, you're insolvent. For 2 decades. This has been the hidden foundation beneath American financial markets. Not in the headlines, not in textbooks, not even fully understood by most investors participating in it, but structural. Imagine a skyscraper gleaming, towering, full of activity. From street level, it looks rock solid, but underground, hidden from view. The entire building rests on hydraulic jacks. Those jacks are what actually hold the weight. Remove them, and the building doesn't stand, it sinks. Japan is the hydraulic jack beneath the dollar system. And in 2025, Japan begins releasing the pressure. Here's what makes this so dangerous. The system was never designed to handle a reversal. Because it wasn't designed at all. It evolved organically, incrementally over 2 decades of the same conditions repeating. 0 rates, weak yen, endless liquidity. Year after year, the pattern held. So the world built everything assuming the pattern would never break. Banks structured their balance sheets around it. Pension funds anchored their return models to it. Sovereign wealth vehicles calibrated their risk assessments to it. The entire edifice of modern finance rests on one implicit assumption. Japan will never tighten. But assumptions aren't laws of nature. They're just beliefs that haven't been tested yet. And now the test has begun. And the Bank of Japan raises rates 0.25%. The yen strengthens. Carry trade positions start bleeding. Not slowly. Immediately. Hedge funds across 3 continents begin unwinding leverage closing positions. Cutting exposure, running for the exits. S. Treasuries. Treasury yields spike. 2% to 2.5% in 3 weeks. That doesn't sound dramatic until you realize what it means. America is now at $38 trillion in debt, the highest in history. And yields are rising at the exact moment the country can least afford it. The FRA OIS spread the measure of how much banks trust each other. jumps from 12 basis points to 38. Translation trust is evaporating. Funding costs spike. Capital flows reverse. Liquidity disappears by the hour. The 10-year Treasury yield breaks 3%. Swap spreads widen. Repo markets start drying up. Cryptocurrency plunges across the board. No liquidity, no bids. Just panic selling. Each data point isolated looks manageable. But together, they're screaming the same message: the funding architecture is fracturing. Then the yen strengthens again, 154.2. More carry positions forced to liquidate. More treasury selling. More upward pressure on yields. The system locks into a feedback loop. Yen strength forces deleveraging. Deleveraging dumps treasuries. Treasury weakness accelerates deleveraging. Each cycle feeds the next. 48 hours pass, then 72, then 96. And with every passing day, the loop tightens. Pension funds massive. Slow-moving institutions that can't react quickly receive margin calls. They're forced to sell their best assets to cover losses on their worst ones. Corporate bond markets freeze. No buyers, only sellers. European banks. Tangled in derivative chains stretching back to Tokyo. Stadt hemorrhaging capital. Deutsche Bank. BNP Paribas. Credit Suisse all over again. The Federal Reserve watches, silent, calculating. Because intervening now would require admitting something they've spent decades denying: that the dollar's strength was never fully autonomous. It was always conditional on Japanese policy. And that admission spoken out loud, confirmed in action, would shatter the illusion holding the entire monetary system together. So they wait, and the pressure builds. The yen hits 154, then 153.8. Every tenth of a point represents billions in losses rippling through the global financial system. Liquidations accelerate. The 10-year yield climbs to 3.2%, then 3.4. Now America is borrowing at rates not seen since before the 2008 financial crisis, but with debt levels 3 times higher than back then. Do the math. Servicing $38 trillion in debt at 3.5% costs over $1.3 trillion annually. Just in interest. That's more than the entire defense budget. More than Medicare. More than anything except Social Security itself. The Treasury market, the deepest, most liquid, most trusted market on the planet, begins to fracture. Buyers disappear. Bid-ask spreads widen. Price discovery breaks down. And suddenly, the world sees it. The so-called risk-free asset was only risk-free as long as Japan kept rates at 0. The moment that ended the risk came roaring back. And it's bigger than anyone imagined. December 2025, the Bank of Japan raises rates officially. Not a quarter point this time. A full commitment to tightening. Tokyo. Trading screens erupt in red. Traders scramble out of yen short positions like a building on fire with one exit. The panic isn't quiet, it's visceral. S Treasury bonds sell in cascading waves. No hesitation, no bargain hunting, just liquidation. Pure and relentless. This is the nightmare scenario every central banker fears, but never says out loud. The moment when funding vanishes, not gradually, instantly. 20 years of mispriced carry trade risk. 2 decades of assumptions leverage. And complacency erased in 8 trading hours. The 10-year Treasury yield explodes to 3.6%. The 30-year breaks 4.3%. Mortgage rates surge past 7.5%, locking millions of Americans out of homeownership overnight. Corporate refinancing costs double. Companies that locked in 3% debt 2 years ago now face 7%, and their margins can't absorb it. Bankruptcy filings begin, and then the real damage becomes visible. America loses its buyer of last resort. For decades, whenever treasury auctions looked weak, Japan stepped in. Quietly, reliably. Not anymore. It's like pulling the central support beam from a tower that's already leaning. As currency dwarfing the domestic supply begins to contract. Not because of American policy. Not because the Federal Reserve decided anything. But because Japan, a foreign central bank, decided to stop subsidizing it. Let that sink in. The global dollar system, the foundation of American financial power. The architecture that's held, since Bretton Woods, dependent on the monetary policy of another country. And that country just walked away in 72 hours. The hidden truth becomes undeniable. The dollar's dominance was never purely American. It was a joint venture. A partnership where one side provided the currency and the other provided the funding. And Japan just withdrew its half. Markets don't collapse in straight lines. They break in stages. First, the professionals exit the ones who see it coming. Then the algorithms trigger programmed sell orders cascading through the system. Then the institutions capitulate, pension funds, insurance companies, sovereign wealth vehicles all rushing for the door at once. Finally, the public panics ordinary people watching their retirement accounts bleed in real time. By mid-December, all 4 stages are in motion. And no central bank on earth, not the Fed, not the ECB, not the Bank of England has enough firepower to stop it. Because this isn't a liquidity crisis you can solve by printing money. This is a structural crisis. A crisis born from 20 years of building a system on a foundation that was never guaranteed to last. And now that foundation is gone. This is the breaking point. The moment when the world discovers what happens when the assumption underneath everything, cheap yen forever dies. The dollar weakens, imports cost more. Inflation returns 8% within months. American banks, holding trillions in treasuries, face capital shortages. Regional banks fail, first over-leveraged, undercapitalized. Caught holding bonds purchased at 2% yields, now trading at 4%. Pension funds caught in margin spirals sell equities to cover bond losses. Tech stocks lose 30% of market capitalization in 6 weeks. 5 million jobs disappear as corporate debt refinancing becomes impossible. Companies that borrowed at 3% now face 7% margins evaporate. Layoffs accelerate. Repo markets freeze solid. No liquidity, no trust, no function. Without repo, banks cannot fund daily operations. The financial system's circulatory system stops. Derivative margin calls cascade through Europe, alarm bells ring across Frankfurt. London, Zurich. Ordinary Americans watch import prices climb weekly. Electronics, clothing, fuel, food. Everything tied to global supply chains becomes more expensive. The financial system undergoes a forced reset and liquidity begins flowing toward Asia. Not because Asia is stronger, but because the yen, once the cheapest funding currency, is now revalued. Capital doesn't chase ideology, it chases stability. And in late 2025, stability no longer resides in dollar-denominated assets. sovereign wealth funds quietly rotate holdings. Saudi Arabia, Norway, Singapore. China all reducing treasury exposure. Central banks diversify reserves, adding gold, euros, yuan. Anything but more dollars. Corporations renegotiate supply contracts in non-dollar currencies. The petro-yuan gains ground. Euro settlements increase. The shift isn't announced, it's executed. Emerging markets that borrowed in dollars face dual crises, currency depreciation, and funding withdrawal. Argentina defaults for the 10th time in a century. Turkey restructures $70 billion in external debt. Pakistan negotiates emergency IMF terms for the 23rd time. Each collapse sends another wave through global markets. Credit rating agencies downgrade dozens of institutions. Overnight bank ratings fall from A to BBB. Investment-grade bonds become junk. Insurance companies exposed through credit default swaps. Face insolvency, AIG 2008 replays but larger, and the European Central Bank, trapped between supporting its own banking system and defending the euro, chooses the former, letting the currency fall to parity with the dollar. By early 2026, the global financial architecture looks fundamentally different. Not destroyed, reconfigured. Power hasn't vanished, it's relocated. And the narrative that sustained dollar hegemony for 80 years, America controls global money, no longer holds empirical weight. The world witnesses something it hasn't seen since in 1971. A monetary system in active transition, with no clear endpoint and no central authority controlling the outcome. Every debt empire follows the same pattern. Borrow to expand. Use finance to maintain power. Depend on creditors. Collapse when creditors shift direction. Rome lost the denarius through debasement, diluting silver content from 95% to 5% over 3 centuries, until trust evaporated and the currency became worthless metal. Bretton Woods collapsed in 1971, when gold reserves couldn't match dollar claims. Nixon closed the gold window because creditors stopped believing. The dollar now enters its cycle of doubt, not from external enemies, not from military defeat, but from creditor reorientation. History shows a consistent truth. Empires don't fall to armies first, they fall to money. When the creditor class loses faith, when funding costs exceed productive capacity, when the currency's privilege becomes its liability, the system resets. It's not moral, it's mechanical. The dollar wasn't destroyed by conspiracy or malice. It was eroded by the same force that built it, the global pursuit of yield. For decades, the world borrowed cheap yen to buy expensive dollars. The moment that trade reversed, the foundation cracked. And what emerges next won't be chaos, it will be rebalancing. Central bank digital currencies, regional trade blocs, commodity-backed settlements. The rise of Asia not as conqueror, but as creditor. The architecture of global money is being rewritten in real time. Not announced in treaties, executed in market movements. The 2026 crisis won't be remembered as a crash. It will be remembered as the transition, the moment the dollar's absolute dominance ended and a multipolar financial system began. Not because America failed, but because the conditions that made dollar dominance possible, cheap foreign funding, compliant creditors, unquestioned trust, no longer exist. This is the pattern of every reserve currency in history. Rise through productivity, maintain through finance, decline through dependence. Sterling dominated for a century, until Britain's creditors, America, decided to stop funding its empire. The dollar dominated for 80 years until its creditors, Japan, China. The Gulf states decided to stop funding its deficits. The mechanism is ancient. Only the names change. And the lesson is always the same. No empire outlives the trust of those who finance it. History doesn't repeat, but it warns. No currency is invincible. Only those who understand the principles avoid the illusion of permanent power. Money doesn't flow toward flags. It flows toward trust. And when trust shifts, so does everything built upon it. In the world of currency, those who don't understand the system become the ones who pay for its collapse. The mechanics are indifferent. The consequences are not. The river of money doesn't follow banners, it follows belief. And when belief moves, empires rise and fall in its wake. If you understand this, you won't be caught believing in the invincibility of any system you'll be watching. For the moment the assumptions change,